So housing is a leading indicator of the US economy. Most people's wealth are in their homes, not in the stock market. The average home has about 14,000 board feet of lumber. So the argument goes that if housing is a leading indicator of the economy, then lumber is a leading indicator of housing, which means that as lumber goes, there's all kinds of ripple effects in terms of future growth and inflation expectations changing for the economy. You may recognize that earlier in October, I said, we might be in a juncture here that might favor a crash in the stock market because of this decline that you could see in that lumber to gold ratio collapsing. Shockingly, it just came right back, which is why it is risk on, which is why, by the way, small caps are leading. Small caps have been just unrelentingly on fire. It makes sense, it is. Why does it make sense? It's confirmed play on housing, which is a play on consumer wealth. Well, then small caps, which are more domestically sensitive, should benefit the most.
What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief, and today's video is about watching lumber and it's about watching gold. It's going to be a little bit different than usual. Just a heads up, tomorrow morning I will be posting the levels on certain indices that I will be watching like I did today on my website in the market update page. So if you want specific charts and levels like I usually post here, I'm going to be posting them on that market brief today. I wanted you to pay very close attention to that intro clip. And the reason why is simply because we are starting to see very interesting things take place with both lumber and gold. What do I mean? Well, let's just get right into it. First off, I brought up a chart of lumber, and right below it is the IWM. This is the Russell 2000. What do we have going on here? Okay, let's look at lumber. This right here is a negative divergence. This right here is a negative divergence. These are the last two negative divergences that took place, the most recent ones here dating back from current to just before September. Now, these blue arrows represent peaks. Okay, so we peaked here and then we started falling on this negative divergence. We peaked here and now we're starting to fall on this negative divergence. Remember what Michael Guy had said in the opening clip. He said that there can be ripple effects in the economy if lumber starts to underperform, if we see big pullbacks in the price of lumber. What else did he say? Well, he also said the reason why small caps are doing so well, it makes sense because of how well-performing lumber is. If housing is a leading indicator of the economy, lumber is a leading indicator of housing. Why? Well, it's just what we saw in that intro clip because of how much lumber it takes to build a home. So when lumber goes up, you can see housing prices rise and vice versa. Now, it takes some time for this stuff to play out, but as you've seen the prices of homes increase throughout this last year, it has been quite dramatic. Now, why am I showing you the price of lumber next to IWM right now? Well, it's very simple. We hit a peak right here. Now, that doesn't mean that it's not going to turn around and go even higher, but I would like to call out two different things here. First off, looking at September. All right, if we look at September, what was taking place in the IWM during this time while it peaked? Well, you can notice right here, lumber gapped up, and this was its peak. And then what happened to the IWM? Well, it was kind of traveling sideways here, and then while this was kind of going down, IWM didn't really realize it yet, so it started moving up slightly right here. And then when we started breaking through this support area, that is when IWM broke through its support, back tested, and fell lower. So one could say that the peak in lumber was found before the peak in small caps, okay? And another thing here is this peak, what did we notice right below us? Well, we're sitting at this resistance, support, so price action on the IWM is at support. We peaked right here and it started going lower. The IWM continued to ramp up higher. Now what I want to call out is lumber falling through this support. This is important to note because if something very similar takes place like it did over here, will small caps follow? Well, if small caps benefit from the rise in lumber, will they benefit from the fall in lumber? Well, I don't know. And what I also don't know is where lumber could be potentially going from here. All I can look at is the future contracts of lumber. And if we do that, what do we have? Well, we have 2021 for January all the way through July. What do you see as the prices here being priced in? This right here is known as backwardation or normal backwardation. It is a pretty steep decrease in a short period of time, but the future market currently is pricing in lower prices than where the spot price of lumber currently is. This is all very interesting stuff taking place. But like Michael Guy had said, there's a couple things we need to watch. Not just lumber, we also need to pay attention to what gold is doing. But why?
Gold, on the other hand, is more of a safe haven risk-off play, meaning that when you have these high-risk periods in the stock market, gold tends to do comparatively better in that flight to safety type of moment.
Gold tends to do better during high-risk environments or flights to safety, potential uncertainty going on. So we're seeing lumber pull back, and we're seeing gold, we're seeing it break out of this falling wedge pattern. Yeah, we still have a little bit of resistance ahead. And like I said, this is gold. What is everything else around gold doing? Well, let's look at the miners. GDX breaking out of a bull flag on the weekly time frame, with the price percent oscillator also starting to slope up but hasn't fully crossed yet. GDXJ, these are the miners, the junior miners. PPO, price percent oscillator sloping up, looks like it's about to cross over, breaking out of this consolidating bull flag pattern. SILJ, this is junior silver miners. Look at this thing break out. Bullish crossover already took place, and wow, screaming to new highs in a very short period of time. So what is this telling us right now? Well, it's telling me that we're starting to see these risk-on environment stuff like lumber, okay? We're starting to see that start to pull away from its peak, and we're starting to see the safe haven assets start to rally increasingly high. This is all very interesting stuff taking place at the beginning of the year. There's some political headwinds up ahead very soon, probably over tonight, I believe, with the whole Senate, and then we have the being conceded in the election taking place here soon. So in the next week or 2 weeks, we have a lot of political uncertainty going on right now, and the market is telling us that it's kind of flying to safety at this particular point in time. But it's been such a short period of time, it's too hard to judge if this is a new trend that is changing and it's going to continue, where 2021 is going to be a volatile type year, or if this is just temporary until we get more clarification about what's going on in the economy, within politics, and so forth. Now let's look at the lumber to gold ratio. The lumber to gold ratio, you can see lumber, it's ticking down right here. Why is that? Well, when this goes down, it means gold is outperforming lumber. When it goes up, that means lumber is outperforming gold. So when lumber goes up like this super quick, we saw small caps do extremely well. Why? Well, we already justified the reason why. Over here, this big pullback in lumber where gold was outperforming it, this was an area of time where the S&P 500 also peaked right before September, and that was a pretty big move to the downside. Now, on Michael Guyad's reports, he does a 13-week rate of change. So when it's above the 13, when it's a positive area, and it is positive right now, that means it's a risk-on environment. So that means you're safely positioned still at this particular point in time in equities. So this signal is technically still risk on, meaning equities are fine at the moment. When it crosses below zero, that's when you want to pump the brakes, and it lets us know that the conditions for an accident are up ahead. Now, the reason why I'm telling you this and maybe not to worry yet is because, one, we don't know where the price of lumber is going, in the near future. We can only look at the data that we currently have and, support and resistance. We can look at technicals. We can look at various other things. The lumber to gold ratio I'd like to call out here was a negative divergence. I think I've done that already previously, and now we're starting to see it pull back here in the ratio as well. Another thing I want to call out is the 3-week rate of change. If you watch that interview with me and Michael, I talk about, okay, why use 13 weeks and not use something else? And he had mentioned, well, you can use something else. He said the 3-week rate of change seems to work pretty good, but the only thing is you can be wrong more frequently, and you have to be more of an active trader positioning in and out of the portfolio from risk on and risk off. Well, as I stated last week, before the first trading day of the year, we went to a risk-off environment on the 3-week rate of change, and we saw a very big aggressive pullback the very first day of the trading year. That was just yesterday. And I pointed out on Twitter, if you don't follow me there, you can follow me there. And I post all kinds of charts there too as well. And I'll start doing that on Instagram too as well, and even TikTok. I'm building out the content, folks. I'm doing my best here. But what I pointed out was in one single day, yesterday touched all the way down to basically the December open. So in one day, it wiped away very quickly and aggressively December's gains. Now we bounced from that low level, but still it was important to notice how aggressive volatility can get. Another thing to pay attention to is utilities. Okay, this is the utilities over the SPY, and you can see here, it's pointing down a little bit, but it was on this aggressive move down, and now it's kind of going sideways a little bit to a little bit down. So is this basing out? Well, look at the RSI, positive divergence here as of right now. Okay, so a positive divergence. I also called this out on Twitter about the energy sector in, I believe it was October. I can't recall the exact date, but the energy sector was getting completely just destroyed comparatively in relative performance to the SPY. But I started noticing strength come in. Now I'm starting to notice the same thing take place currently right now. And now the rate of change that is on his beta rotation strategy, and I'll link his white papers in the description below and the interview, he uses a 4-week rate of change. Now, when it goes above 0, the following week you want to go risk off. So this is still a risk on environment according to his research as well. Now, what's something else that's very important to look at as we're talking about small caps and the SPY? Well, what's taking place with small caps over SPY? And you might be thinking, Mike, why are you talking so much about small caps and the SPY and lumber and gold? Well, it's because, before I get back to this, let me show you this actually, is because we're looking at the charts long term with negative divergences, huge overextensions, and on top of that, a lot of these charts are running, if not potentially just over, a massive area of resistance. So this is small caps dating back all the way to 2000. You can see resistance, 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 and now we're seeing a little bit of a pullback and disconnected from the 5 EMA. On the S&P 500, what's very interesting is we found support right here. When we broke down, it was resistance, 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 and now we're just slightly above it on a pretty large negative divergence. And it's doing so without anybody really paying attention to what happened with the inverted 10-2 yield curve. You can see here in 2007, even earlier, 2006, we were getting these warning signs of an inverted yield curve. And you started then seeing it start steepening quite aggressively after that. And I have this inverted just because it makes it look easier to look at for me. And then you started seeing the market really take a hit to the downside. Well, guess what? We inverted right here in 2019, mid to late 2019. And guess what? Yeah, we saw this March really aggressive move to the downside, and then quantitative easing, infinity came into place, and we pushed all the way back up. But notice how the curve is still steepening here, not quite to these standards, and we'll get into the yield curve here in just a moment. But I wanted to point out, yeah, the market's at these really just interesting levels right now, and not to mention we're at a very interesting time with supposedly handing over the presidential election, and then we have the pandemic. So it's just very, very interesting. I find this stuff very interesting to be paying very close attention to. So back to this chart. Okay, I've been talking about small caps being super overextended. Who hasn't been talking about small caps being overextended? It's crazy. I want to point this out. We're looking at the relative performance from small caps to the SPY. This is the 200 period moving average. This is the 50 period moving average. What do we see taking place here? Well, We see right here, we're seeing it peaking out. These 3 arrows represent peaks. Where are those peaks at? Well, they're hitting in to the 200 period moving average almost perfectly. And then what happens when it peaks out? Well, the SPY starts performing better than the small caps IWM. We see this peak, boom, to the downside. What is performing better? Well, SPY over small caps. All right, and now we're at this peak here too, which could represent consolidation and we potentially break above it, or this could represent, if history replays itself, that the SPY is going to start outperforming the IWM. Now, what does this mean for the IWM? Well, it doesn't mean that the IWM is going to fall apart here. Okay, it could still continue to rise, but the SPY would just say that it's rising at a more faster rate, which would mean the relative performance of the SPY is stronger. Or the IWM can fall pretty aggressively and the SPY not fall as hard. That means that the SPY would be performing stronger relative to the IWM. And this right here, if we're playing history out, this is showing us right now, and this is on the weekly candles, all right? This is showing us that we got to pay close attention to this peak area here. Okay, we had the the positive the overbought territory, the RSI's overbought territory right here as it hit into this level. So if we start sinking back down to the 50 period, what does that mean once again for the small caps? Interesting stuff. Let's go over just a few indicators here. The VIX is still holding a pretty decent area of support. We closed at 25.34. Okay, and it's still curling itself up, kind of cupping up. You see the RSI cupping up. You know, what's really going to matter here the most is what takes place during this whole political, atmosphere going on right now. Who's going to win the Senate is going to be two things. It's going to be very binary. It's going to be bullish or it's going to be bearish. If it's bullish and the market wants to head higher, we can very well push the market a lot lower. So this is something to consider right now. This is the Pring bottom fisher. What we pointed out a while ago was when this crosses over above the black line, we looked at the 2 previous times this happened and we saw some pretty aggressive short squeeze that really just got completely corrected to the downside. Well, you can see right here we crossed over, so we said, hey, you never know, we might see some sort of a short squeeze. Well, we did move a little bit higher, but it looks like it's about to start crossing itself back over here in the very near future. And one could argue that, okay, maybe we did get a little bit of a bump up right here, and then we just got that full correction right there, and maybe that's already in or being priced in. But it is interesting to show that the crossover here, we moved a little bit higher by not much, not nearly as aggressive as it was here in August and how it was here in June, but both times, now technically a third time, but we haven't crossed back over yet, we found a way to correct ourselves throughout that transition. And you can see here, it did it in mid-December. And yesterday's trading day wiped out, pretty much backdated all the way to the opening of December and then bounced a little bit from that level. As we're watching the market continuing to kind of, chop back and forth throughout all this political headwind, what are other signals telling us? Well, look at the BP NDX. A big drop today, 2 points, 2.67% down to 73. Still technically bullish, but look at the RSI dropping below 50 on a negative divergence still. And then you look at the BP SPX and it's drifting lower and lower still as well. So what is this telling us right here? Well, the market is telling us that it's one, really undecided. It's like a doji candle, okay? Doji candles are indecision. And we're seeing the market kind of have a good day today, kind of recover a little bit, but it did so also on a negative breath. And these negative breaths take place very frequently as the market continues to make new highs, but it doesn't result in the best ending. So these are all these things to consider. Yes, the market can go higher. I'm not saying that it can fall apart, but we need to be very aware of everything that is taking place. If you want to ignore these things, then by all means, why even bother watch these videos? It doesn't make sense to if you're not willing to learn and listen and see everything that the market is currently telling us. I'm not making this stuff up here. I'm just becoming aware of the charts and I'm sharing them. The dollar is a very important thing to watch too. Why? Well, gold has been doing really good. What's gold tied to? Well, gold, it's negatively correlated to the dollar. So when the dollar continues to break down, gold is moving up. Now that's not always a one-for-one correlation. There are times that changes. I'm not saying that, and I'm not, making the, a fact that that's the case. But for the most part, a lot of people would say, yeah, when the dollar goes lower, gold goes higher. It takes more dollars to buy the same amount of gold. That's why the price of 1 ounce of gold, the spot price, would go up. Now, gold just got hammered today. Hammered. 89.41, closed below 89.5. And the trend is bearish, but it's still holding a little positive divergence here, which is like the hope that it can continue to rise. And a rising dollar would put pressure on gold. It would put pressure, depending on how aggressively it moved, on equities. Okay, what's the Fed doing right now? Expanding the money supply to just ungodly amounts. Okay, in 2020, they increased the M1 money supply. And by the way, if you haven't watched Sven's video called The Ugly Truth, I posted that on Twitter. I retweeted it. That's a very long video, and it has just an amazing amount of data, and he actually shows clips of him talking about, what he's doing with the M1 money supply, or, what does that actually mean? And it's him just basically saying, well, it's in theory, yeah, you can just call it printing money, is his words. Positive divergence on the MACD, positive on this. When you print money, when you expand the money supply, what does that do to the value of the dollar? Well, the value of the dollar deteriorates. So you can see here, we're, May, I wish I had a longer term chart, which I do actually. Let's go to the weekly time frame. You can see here in 2020, okay, yeah, we had this move up, this flight to safety move. Why a flight to safety? Well, the dollar's a reserve currency. So when we see mayhem take place in the equities market, you can potentially see a flight to safety, and that's what we saw here. But now, what did the Fed do? Well, they stepped in, increased the money supply, expanded the money supply. You can define that as inflation, the expansion of the money supply. There's dictionaries, old dictionaries that actually define inflation as the expansion of the money supply. And what are you seeing happen to the dollar? The dollar is falling like a rock. However, look at the structure of this weekly time frame. Falling wedge, positive divergence, positive divergence. Look we had a flight to safety here, 2016 to early 2017, and then same structure, we broke out of it. We're at this level of support. What is this telling us? Are we setting ourselves up for another flight to safety move here? If so, what would that be? I don't know. I can't predict that, but I can say that if we start breaking below these levels here, 88, we're gonna have to start looking at the monthly time frame, the 200 period moving average, to see if it can bounce from those levels. But right now, we're still structurally in this bullish pattern, even though, it's getting pretty darn beat up right here. Let's look at bonds and yields. Okay, TLH, this is the 10 to 20 year treasuries. You can look at all kinds of different ones here, but what have we been seeing go down? Well, we've been seeing the price of bonds sink. Blah, da, 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 channeling back and forth in this bear channel. However, since, mid-October, what is the RSI doing? The RSI is showing us some strength. It's moving up higher lows. It's going higher and higher, but it's still obviously below the 50 marker. We're at 43.23 now. As the price action continues to drop, that's a positive divergence taking place. Now, another thing to note is the basically time frame from November to now, higher lows taking place, but we're also still putting in lower highs here. That's a symmetrical triangle, and we're in this area of resistance. The bonds have been going up, okay, since November, and equity markets have been going basically, through the roof as well. But we're putting in higher lows here. If we start breaking out of this, that might show us, hey, this could be a flight to safety move. We're going risk off, environment. However, today, I don't know if this is a little head fake to break this trend line or if we're going to continue to head down. The RSI came through this little trend line basically. We're seeing volume increase, the selling pressure, but it's still held the trend line. So, what's going to drive this market? Where are we going to see the aggressive move? Because really it's been going sideways now since December. I feel like there's some more moves here to come very soon. And, it makes sense. Look at yields. Yields had a little bit of an uptick today, okay? 0.96. The spreads increasing, steepening, whatever you want to say. Higher lows, and on the 30, higher lows as well. But where are we struggling to get through? 1 on the 10-year, and just below 1.8 on the 30-year. Okay, what happens when yields continue to rise? Well, that's good for financials. It's good for banks. Why? Because they borrow short-term, they lend long-term. So it's going to be interesting to see here. An aggressive move in either direction can send ripples throughout the equity market. So we got to be very cognizant of that as well. Okay, a sharp, aggressive spike. That's all I got for you on today's market brief. Let me talk really quickly on the conclusion of everything. The reason why I did this differently today is because of the correlation and some things taking place with two very important commodities, okay? Lumber and gold. Gold we're seeing get stronger, which represents a flight to safety move, and we're seeing lumber get weaker, which can tell us that there could be ripple effects in the near future if that trend continues. And I say that with an if, okay? Like I said already, things can flip on a dime right now. This is too short term. That's why on the rate of change, we look at a 14-week rate of change or 13-week rate of change, because that represents 3 weeks of data, and that's when you get trend shifts that can last a little bit longer. All right, everybody, that's all I have for you on today's Daily Stock Market Brief. Look for the post tomorrow on my website. I'll post it on Twitter. I'll let you know on Instagram as well that I'll be posting the key levels to keep an eye on and some charts that I typically post here on the Daily Brief. Hope you enjoyed today's episode. I'll see you later.